Hey, welcome back. Let me tell you something that happens in crypto every single day. Someone discovers a new project. The website looks professional. The social media following is large. The promises are incredible. The community seems excited. And influencers are talking about it everywhere. So they invest, sometimes a little, sometimes a lot. And then one day they wake up and the token has lost 90% of its value, or the team has disappeared entirely, or the project that was supposed to revolutionize an entire industry has simply stopped existing. This is not rare. This happens to thousands of investors in every single market cycle. And the painful truth is that in most of these cases, the warning signs were there from the beginning. They were just ignored or not recognized because most people do not know what to look for. Today, that changes. I am going to walk you through the most important red flags that every crypto investor needs to recognize before putting any money into any project. These are the warning signs that professional investors spot immediately and that consistently separate the people who protect their capital from the people who lose it. By the end of this video, you will be able to identify dangerous projects quickly, protect yourself from the most common crypto investment traps, and make far more informed decisions with every dollar you put into this market. Let us get into it. Anonymous teams with no verifiable history. The first and one of the most important red flags is an anonymous team with no verifiable track record. Now, let me be clear about something right away. Not every anonymous team is a scam. Bitcoin was created by an anonymous founder and it became the most valuable cryptocurrency in the world. Some legitimate projects do operate with anonymous teams for valid reasons, including privacy and security. But here is the critical difference. Bitcoin earned its credibility through years of open source code, transparent development, and a decade of working exactly as described. It did not ask you to trust the team, it asked you to verify the code. Most projects with anonymous teams are not Bitcoin. They are asking you to trust them with your money before they have established any track record of delivering on their promises. When a team is anonymous, you have no way to verify their credentials. You cannot confirm their claimed experience. You cannot research their track record at previous companies or projects. You cannot hold them accountable if they take investor funds and disappear because you do not know who they are. This is how rug pulls happen. The team promotes the project aggressively, raises significant investor funds through token sales or liquidity provision, and then vanishes completely. With no identities attached, there is no legal or social recourse. Here is what to do when you encounter an anonymous team. Search every team member name that is provided, even pseudonyms, along with words like scam, rug pull, or fraud. Check whether their social media accounts are newly created. Look for whether they have any history of previous work in the space. And apply an extremely high standard of evidence to everything else about the project before considering any investment. Anonymous teams require everything else about the project to be exceptionally strong and verifiable before they deserve your trust. Unrealistic promises and guaranteed returns. Red flag number 2. Any project or person promising guaranteed returns or unrealistic yield percentages is either running a scam or does not understand what they are talking about. Let me be completely direct about this. There are no guaranteed returns in crypto. There are no risk-free yields of 100% annually. There are no protocols that can sustainably pay out thousands of percent per year indefinitely. When you see these promises, you are looking at one of two things. Either a Ponzi scheme that pays early investors using money from new investors until it inevitably collapses, or a project using unsustainably high token emissions to create the appearance of yield, which will eventually destroy the token price and wipe out the real value of your principal. Both of these end the same way. The early participants make money, the late participants lose everything. Here is how to spot this red flag in practice. Watch for any project promising annual percentage yields that sound extraordinary. Anything above 20 to 30% should raise questions. Anything above 100% should raise serious alarm. Ask specifically where the yield comes from. Is it generated by real economic activity within the protocol? Or is it simply new tokens being printed and distributed? Watch for language like guaranteed, risk-free, or certain returns. These words have no place in legitimate investment communication because they are never true. Watch for urgency tactics, limited time offers, exclusive windows. Join now before it closes. Legitimate investment opportunities do not disappear if you take a week to research them properly. Real returns in crypto come from identifying genuinely valuable projects early and holding through growth. Any promise of shortcuts to guaranteed wealth is a trap every single time. Excessive insider token allocation. Red flag number 3. When founders and early investors control the majority of token supply, regular investors are structurally at a disadvantage from day one. Here is why this matters so much. When a small group of insiders holds 50, 60, or 70% of total token supply, they have enormous power over the market. When their vesting periods end and they are allowed to sell, even a small percentage of their holdings entering the market represents massive selling pressure relative to normal trading volume. And here is the uncomfortable reality. Many of these insiders receive their tokens at prices that are a tiny fraction of the public market price. Even selling at a significant discount to the current market price generates enormous profit for them. Regular investors who bought at the public price have no such cushion. How to identify this red flag? Find the tokenomics breakdown in the white paper or documentation. Add up the combined allocation to founders, team, and private investors. If that combined number exceeds 50% of total supply, proceed with extreme caution. Also check the vesting schedule. Short vesting periods of 6 months or less mean insiders can flood the market with tokens very quickly after launch. Short cliffs combined with high insider allocations is one of the most reliable predictors of post-launch price collapse. Healthy projects give insiders meaningful but not dominant allocations and require them to vest over 2 to 4 years minimum, demonstrating genuine long-term commitment to the project they are building. No real product or working technology. Red flag number 4. A project that has been operating for more than 6 to 12 months with no working product is a serious warning sign. Ideas and white papers are not products. Roadmaps full of future promises are not products. A professionally designed website with impressive graphics describing what a project will eventually do is not a product. A product is something you can actually use today. The crypto space is filled with projects that raised significant funds based on compelling visions and detailed roadmaps, and then never shipped anything meaningful. The white paper described revolutionary technology. The team gave interviews about how they would change the world, but when you visit the application, there is nothing to interact with. Or what exists is so early and broken that it cannot realistically be described as functional. Here is the practical check. Go to the project's application or protocol directly. Try to use it. If you cannot complete basic interactions without significant problems, what you are seeing is not a viable product. Check the GitHub repository. When was the last time code was committed? Are there regular updates from multiple contributors? A GitHub that has not been updated in months while the team is actively marketing the project suggests the development has stalled or that marketing has become more important than building. Projects that prioritize building over marketing are the ones worth watching. The best projects often have the least flashy marketing because their team is spending their time shipping code rather than producing promotional content. Paid promotion without disclosure. Red flag number 5. Aggressive influencer promotion without clear disclosure of paid relationships is one of the most widespread and damaging patterns in crypto. Here is how this works. A project pays influencers, sometimes very large and well-known ones, to promote their token to their audience. The influencer receives tokens or cash payment in exchange for creating content that presents the project positively to their followers. In many cases, this promotion does not clearly disclose that it is paid advertising. The influencer presents the project as something they personally discovered and believe in. Their audience trusts them. They buy the token. The project founders and the influencer who received tokens at a much lower price or for free sell into that buying pressure. The audience loses, the promoters profit. How to protect yourself from this pattern? Be deeply skeptical of any project that is promoted by many influencers simultaneously in a short period of time. Coordinated promotion campaigns are often organized by the project team to create artificial momentum. Search for disclosure statements. Legitimate sponsored content should clearly state that it is paid promotion. Absence of disclosure when promotion is happening is itself a warning sign. Research the influencer's track record. Have their previous recommendations performed well for their audience? Or is there a pattern of promoting projects that subsequently declined significantly? The most reliable information about any crypto project comes from independent researchers who have no financial relationship with the project. Always prioritize that type of analysis over promotional content from any source. Copycat projects and plagiarized white papers. Red flag number 6. Projects that copy existing white papers, clone established code bases without meaningful improvement, or simply rebrand existing projects with a new name and token are rarely worth your investment. The crypto space moves fast. New projects appear every day, claiming to be the next version of an established protocol or the combination of two successful existing ideas. Some of these are genuine innovations, building on proven foundations. Most are lazy copies, trying to capture investment interest without doing original work. Here is how to identify this red flag. Search the white paper content. Copy specific technical sections and paste them into a search engine. If they appear word for word in another project's documentation, the team copied their white paper. A team that cannot write their own technical documentation almost certainly cannot build original technology either. Compare the GitHub code to established projects. Legitimate forks of open source projects are common and acceptable in crypto. But if a project is presenting itself as an original innovation, while its entire code base is an unmodified copy of something else, that is fundamentally dishonest. Ask what is genuinely new here. If you cannot identify a clear technical innovation or meaningful improvement over existing solutions after reviewing the documentation, the project is probably a copy with a new token rather than a genuine contribution to the space. Let me bring all of these red flags together into your complete protection framework. Red flag 1. Anonymous teams with no verifiable history. Require identity verification and track record evidence before trusting any team with your money. Red flag 2. Unrealistic promises and guaranteed returns. Sustainable yields in legitimate protocols come from real economic activity. Extraordinary yield promises are almost always unsustainable or fraudulent. Red flag 3. Excessive insider token allocation. Combined founder and investor allocations above 50% with short vesting periods create structural selling pressure that hurts regular investors. Red flag 4. No real working product. Marketing without shipping is a warning sign. Check the application directly and examine GitHub activity before believing development claims. Red flag 5. Paid promotion without disclosure. Coordinated influencer campaigns often signal that founders are trying to create exit liquidity rather than genuine community interest. Red flag 6. Copycat projects and plagiarized documentation. Original teams building original solutions write their own white papers and contribute original code. Here is the most important thing I want you to remember. In crypto, the projects that shout the loudest, promise the most, and appear everywhere at once are often the ones you should trust the least. The best projects in this space have earned credibility through years of consistent building, transparent communication, and real delivered value. Excitement is not evidence. Hype is not validation. Influencer promotion is not due diligence. Your ability to recognize these red flags quickly is one of the most valuable skills you can develop as a crypto investor. Because avoiding bad projects protects your capital just as effectively as finding great ones. Every dollar you do not lose to a scam or a poorly designed project is a dollar available to invest in the genuine opportunities that this market consistently produces for those who do their homework. If this video helped you see warning signs you were not previously aware of, please hit the like button and subscribe. Share this with one person you know who is investing in crypto without doing proper research. This video could genuinely protect them from a serious financial mistake. Drop a comment below and tell me honestly. Have you ever invested in a project that showed one of these red flags and you missed it? What happened? I read every comment and your experience might help someone else avoid the same mistake. I will see you in the next one.